thank first Goodwin and Columbia Business School for having me this morning. Very proud to be here, proud to be the first alternate speaker to open this. No one actually said that, but we'll go with it. We have a long history with Goodwin. It goes back decades in the REIT space. Also, Columbia Business School has great representation within my group. Some of your alumni are in the audience. I'll try to move through my content pretty swiftly. I think you have a great day ahead of you, and again, I'm thrilled to be part of it. So the agenda I want to cover this morning is a little bit of background on my platform where I sit, briefly touch on US macro environment. We'll talk about real estate capital markets in depth and the lending markets. I want to do a kind of long-term look back on M&A transaction activity and capital flows. We'll talk about valuations very briefly. I spend a lot of time in data centers, so we'll do a little bit of a deep dive there. And I'll avoid making predictions, but in the eighth point there, I do want to talk about some of the trends that we're all observing in the real estate advisory space. So this is just a little background on the group I sit in. Investment banking has 13 offices worldwide. You can see our highlighted presence from a real estate standpoint. I'm one of roughly 100 real estate banking professionals, and our bread and butter is all the conventional advisory and capital sourcing mandates. It's M&A, it's IPOs, follow-on equity, unsecured debt, leverage finance. We're very active secured lenders. And interestingly, private capital markets are increasingly a focus area of the firm and our group, both on the equity and debt side. We've had the privilege of working on a lot of marquee assignments over the last couple of years. I'll take you through some of those. And as I said, we have a lot of Columbia Business School students in our ranks. And they've had, in some cases, new joiners, and in others, managing directors in the group. We have two summer associates coming in too. So we're delighted with the farm system that Columbia Business School provides here for us. Just a little bit of background on myself. I started my career as a CPA. It was a very brief career. I've had since 26 years in investment banking. I started in M&A and dedicated myself to REITs in 2007 when I came over to Morgan Stanley. I do have 3 kids. My wife and I are raising 3 kids. It's a little bit of their artwork there. We're proud dog parents as well. They won an award recently at my kids' middle school. I have my undergraduate degree from Boston College. I don't have an MBA. I'm not sure I was Columbia MBA material. But I'm a late bloomer. I've had a lot of transaction success in real estate with some of the most prominent REITs. Some of them I've worked with on IPOs. I've sold them. And I think the thing that we're proudest of in the group is the repeat business element of people that keep coming back to us. So as I highlighted, this is a little bit of data on US macros. And the challenge with this chart is they're stale almost as soon as you print them. For instance, the market's pricing in 2.9 cuts, almost 3 cuts, 75 basis points by the end of the year. The Morgan Stanley prediction is for 1 cut, but that doesn't get updated in real time. We're visibly seeing slowing consumer, a cooling labor market, uncertain impact of tariffs, immigration slowing quickly, and we think that's going to impact not only GDP growth, but our target for inflation. We think that inflation could be sticky, and it's going to be very hard to get to the 2% Fed target. I'll delve into some of the headlines on what's making these predictions incredibly difficult this year. So I think today is like day 45 of the first 100 days of the new administration. We're in a very, very rapidly changing world. I know you have a panel today on AI adoption. The direction of interest rates is very uncertain. We have onshoring but slowing labor. And then on the headwind side, geopolitical tension, which changes daily when you wake up. Immigration, which I think was telegraphed by the administration, but is really going to have an impact on new job creation, and tariffs and trade, which are literally an hour-to-hour topic on Wall Street. I want to talk about the REIT capital markets principally today, but you have to compare them to the overall markets to get context. And the yellow and green line above are the S&P and NASDAQ indexes compared to the VNQ, the REIT index. So this massive outperformance since the start of 2024 has several implications I'm going to go into in a minute. On the right side, you can see the broader market multiple on the top trading at a substantial premium to historic averages, and the REIT market multiple closer to its norms. Another deep dive on this is kind of a long-term retrospective on how REITs have traded versus the S&P, and then you have a year-by-year comparison over on the right. So, at the start of the 2000s, REITs had an incredible run. Outperforming the S&P from 2000 to 2006 every year. It was on such a great run, I decided to dedicate myself to REITs. The timing wasn't optimal because shortly thereafter we went into the global financial crisis, and what was kind of a 10-year forgotten decade of S&P returns that were roughly flat then accelerated into massive outperformance in the S&P. And I want to focus on the top right, the difference of the S&P versus REITs in the last 5 years. The massive outperformance of the S&P, I think, is a reason for optimism in real estate stock prices and private market valuations because of the denominator effect. I know that a lot of capital allocators, manage their real estate exposure to a pie chart, and this just means that they're going to need more real estate exposure to rebalance. And again, I think it's an optimistic sign. Real estate and broader capital markets on the equity side, we've seen broadly on the left, a really fantastic recovery in deal volumes from 22 to 23 to 24 in the US registered deal volume space. And on the right side, we dive into REITs. The white boxes at the top row are, the net new adds or losses in the REIT space. There's about 156 REITs in the index. And last year was the first year in a while that we added both number of REITs and market cap to the REIT sector, which is good trend. That comes from several IPOs and a direct listing offset by lower privatization activity. Here we'll spend a minute on NAV premiums. We are sourcing a lot of this data from our friends at Green Street, some of whom are in the audience. We see the market at a 16% NAV premium. That compares to the longer-term average of 10%. We compared that to consensus data, which is more like a 5-6% NAV premium for the market, but a lot of important detail is obscured by the average. Another interesting observation in the deal activity space is, again, we do a long-term look back on some of these statistics, and something that was kind of a new phenomena in 2015 is this light green bar, that's ATM issuance. It's a product that didn't even really exist and now has grown to dominate, as you see on the right, a lot of the equity activity that we're seeing. There's been relatively little event overnight activity, and IPOs are very lumpy. Last year was a very good year for IPOs in terms of deal count and total dollar volume, but it's very hard to predict. CMBS markets, again, we have volumes for this space on the right. The bar on the far right is year-to-date volumes in non-agency CMBS on track to outpace last year, and last year was a massive recovery. So CMBS is working for every property type, including Class A office. It's dominated by refinancing, so there's an upside case when transaction activity picks up. New assets could be financed in this marketplace, and I think this portends well for the liquidity in our space. Borrowing costs tightening, so all good signs. REIT issuance for unsecured bonds, also pretty healthy, up 27% in 2024, above the long-term average for the first time since 2021, and secondary spreads coming in tighter. I think there's a desire for issuers in the REIT space to capitalize on the low base rate, and I think there's a desire for investors on unsecured to get more REIT exposure, which has been kind of on the slow side of late. This is a long-term chart on deal activity in the REIT space for M&A, going back all the way back to 2000. So, as I mentioned, I jumped in 07. Not great timing because 08, 09, 10, all the way to 12, there were only 2 deals, one of which was Prologis AMB. But then the space picked back up. Private activity began more active since 2020. Blackstone's had commanding share of that space. So it's very hard to generalize and say what a normal year for M&A is. But we see the level of dialogues at a healthy level. And I'll just do a little bit of a shorter retrospective going back to 2021. And this isn't everything. We couldn't fit all the logos on the page, but there was substantial activity in 21, also 22 coming out of COVID. Interestingly, this is when 3 of the public REITs who focus on data centers were privatized by large private equity investors. So that's QTS, CyrusOne, and Switch. Those were prescient bets done ahead of the AI euphoria. But there's a lot of other M&A activity in conventional property types, alternative sectors. We have new emergence on the private side. We're seeing more foreign capital enter the market space. We're seeing large portfolio deals getting done. Again, I think this is a factor of healthy financing environments and investors that view this as a favorable entry point in the cycle. Another trend we've seen is a rise in shareholder activism. Over the last decade, this used to be a place that was almost immune from activism. I'll talk about that in some of my concluding remarks, but that tends to drive a little more activity. Private capital, again, very, very active and coming from sources that we hadn't anticipated, frankly, overseas and other places. So I want to talk about asset level deal value for a minute. It's been on the slower side of late, recovering a little bit in recent quarters. And dry powder is still available on the private equity side globally, trending down a little bit. Fundraisers have been trending down a little bit. And I think these 2 factors are related. When we see more velocity in the asset level market, we're going to see LP capital freed up and fundraising pick up. It's also noteworthy that of the capital that was raised, it's largely opportunistic, seeking high returns. The core capital raise has been very, very slow of late. Again, a little bit more data on NAVs. And I mentioned that the average is obscure, important detail. The average implied cap rate is the blue row, that's 5.7. The average applied cap rate by Green Street is 6.1. But then if you look at the detail per major food group, it's pretty different, actually. You have healthcare trading at effectively all-time tight implied cap rates, a lot of sectors trading on or around NAV, and just a few trading wide of NAV. So if we dive a little bit into subsector performance last year and to start off this year, these are stock price total returns. Data centers, the clear winner last year. Malls had a great recovery. Healthcare, consistent with those implied cap rates I just showed you. They were the leaders. And from year to year, we track this and present it throughout the year to our clients to say, who's trending this year? Industrial recovery, healthcare again, malls year to date. So it's just increasingly difficult to make sweeping statements about the REIT space because it's made up of a lot of different subsectors, many of which are alternatives. This is some data on stock price at the beginning of 2022 and the evolution of forward FFO per share. And I think for REIT management teams, this trend is a little vexing, right? Because they are growing FFO per share very substantially, and in many cases, not at the stock prices that they enjoyed at the beginning of 2022, with some noteworthy exceptions. This is a little bit of data on the space for digital infrastructure and data centers in particular. I know you have a breakout later today on this, but as I said, I spent a lot of time focusing on the data center sector, and we're seeing incredibly favorable trends from very influential and reputable sources and market participants and people disclosing their CapEx on what expectations are. So like just to put out a couple anecdotes, more data has been created in the last 3 years than in all of history combined, a trend we expect to continue. This is measured in zettabytes. A zettabyte is 250 billion DVDs. I had to Google that myself. Data creation volume is also heading up exponentially. We see a shift in big data, workloads in the public cloud, IT investment. Everything's pointing up and to the right. It's a little bit of a spoiler for the next couple slides. So, we know that power is going to be a constraint. Every segment of the market is growing rapidly, including enterprise and colocation. I think of those as the segments that have been showing good trends and continue to, and sometimes get lost in all the talk about hyperscale and AI, but those are healthy segments of the market. And then the hyperscalers are only a massive accelerant onto these growth trends. We're seeing a 16% CAGR in power required in the next few years into 2028. And every segment of data center use is growing. Enterprises, content, hyperscalers. It's important to remember that all these companies, in particular the hyperscalers, are competing on different playing fields. And I think we'll continue to do so for quite some time. AI, an incredibly topical, accelerant in the data center space. It's a component to REIT growth strategies. It's critically important in the broader market. It's the underpinning is in data centers. It's showing up in new leasing. Lease sizes are growing exponentially in the market. I mean, these numbers are astounding. CapEx per hyperscalers, which were just reaffirmed post DeepSeek, just continue to grow. Now, granted, this is not all data centers, it's GPUs and other content within a data center, but it all portends well for continued growth in this space. And then the obvious question everyone's trying to solve is, how are we going to power this? And I don't have the answers. Morgan Stanley is approaching this question with a joint task force. We're going to all our clients in power and utilities, in tech, in telecom, real estate, of course. We're doing power summits, making connections, getting people to collaborate in ways they never have before to address this need. We see total power used by generative AI going in 2027 up 5 times from 2024. And there's a massive shortfall in the country for US data center power that's going to get addressed. And then I listen to too many podcasts, but everyone's talking about Javon's paradox and how, lower cost and increased computing power begets more compute, not less. It only extends the uses for AI and consumption. And it will grow baseline demand for compute. And people far smarter than me are saying this, right? Andy Power at Digital Realty, Adair Fox-Martin, Andy Jassy, Sam Altman. I think compute is going to be the currency of the future. And I think we're very much believers in that trend. And we're seeing it in private markets as well. So I want to go through some key themes. I said at the onset, I don't want to make predictions about rates or stock prices. It's beyond my capabilities. But these are some of the things that my partners and I are seeing in boardrooms, in investor dialogues, and private capital. Commercial real estate supply is in a very favorable place for REIT owners now. We see it as bullish. Supply is decreasing in every property type. Starts have been low. Development economics outside of data centers have been challenging. Development financing's not been easy to get. As far as we can see, there's limited deliveries coming online in the next few years, which is a healthy fundamental. I referenced earlier activism in defense. This is a driver of transaction activity. There are campaigns against REITs targeting alleged underperformance. I'll use air quotes on alleged because it doesn't actually have to be actual underperformance. They themselves don't get criticized, but we think that is a trend that's going to continue, and there's even fewer REITs to be choosing from to attack. So I think we're cautioning all of our clients to keep their guard up and have action plans for activism. And then the other point on activism defense is that there was a time when people considered it like uncouth to make an unsolicited M&A approach. I think those days are gone. People are making calls really out of the blue, being aggressive, believing that this is the time of the cycle to strike. REIT IPOs, I showed you some data how we grew the space last year. The market depth has been tested for REIT IPOs. Lineage was over $5 billion last year, a record. There are large platforms and other property types owned in closed-end vehicles that may seek liquidity through the IPO markets. We're seeing participation from crossover investors, from technology investors and generalists in IPOs. And then index demand is increasingly important in our space and in the broader public market. That's upwards of 40% of long-term demand that's pretty much automatic for large cap REITs. REIT equity, I showed you a time series on prevalence of ATM usage. We see that continuing with some very, very heavy users in the market every day on that. Event-related equity is much, much harder to predict. It's episodic. We think it's, investors are encouraging management teams to be bold. Those usually coincide with large announcements. And we have clients looking to go on offense and be bold. The aftermarket data and REIT trading performance is suggesting that there is a reward for being on the front foot on acquisitions and equity. Corporate separations and spin-offs, another trend that's kind of developed over the last decade or so. We're seeing more and more spin-offs. We think that simplification resonates. There used to be a large population of diversified REITs that's dwindled down. Investors want to be making the capital allocation decisions and the choices on where to place money. A separation can accelerate a transformation, serve as a catalyst. In many cases, the sum of the parts is value creating versus the status quo. And, there's increasing interest from investors in specialized asset classes, which can be facilitated by corporate separations. The LP community, we are hearing increasingly that there's a strong desire to return capital to LPs. That desire is related to a GP's interest in wanting to do that, to raise new funds, to reverse the trend that I took you through on new fundraises. So we expect that'll be a driver of transaction activity in the near term. And then, interestingly, continuation funds, I think, have a place in today's next chapter of private equity-owned vehicles. This is particularly true in spaces that are hard to aggregate, that have scarcity value. We're hearing investors saying, we understand this is in a closed-end fund, we like exposure to this asset class, we want to restructure it in some other way. I'm afraid the Oscars music is going to come on soon, so I'll get through this last page quickly. Consolidation, I think, in the REIT space in general, there's acceptance that scale has benefits by all stakeholders, be it equity investors, debt investors, generalists. In fact, for generalists, size and liquidity are a prerequisite for investing. and people notice that. In some cases, a merger can address a succession concern. And we've also seen instances where shareholders with nothing but public information are very front-footed on making suggestions. They're not shy these days. So sometimes that could be the seed that starts a discussion, leads to M&A. I went on about data centers, just some closing highlights. The demand is incredibly strong and getting stronger. The development profits are superior to conventional property types by a wide margin. Interestingly, core capital hasn't emerged to date in size for this, but our expectation is that it will. We know it's happening. I think there's going to be a first mover advantage. The tendency in a lot of these data centers is basically credit quality that's superior to anything else in the world. And we think it's a property type that appeals to core investors. And there's a lot of product out there to be addressed by core investors. Power availability, that's really the only check in the space and the growth. And then finally, I mean, it's in the headlines. The new administration views leadership in AI as a national imperative, which is only good news for the data center space. Trend 10, we are seeing a bit of a convergence and a grouping together of infrastructure and real estate as, quote, real assets. There's an increasingly wider aperture of what is deemed to be infrastructure, be that marinas in recent news, digital assets and data centers, cold storage. And then I'll wrap with real estate lending markets. All markets are healthy, signs pointing towards benefits to borrowers. Absent a recession, and granted, we've seen recession probabilities tick up a little bit in the last week, we don't expect a lot of distress. A lot of loan modifications have been done, so we don't have a long watch list of problem assets out there. And lenders are competing and aggressive in wanting to offer the most favorable terms for borrowers. So I think, unfortunately, the base rates are higher than they had been, come down recently. I think it's a favorable time to be a borrower, and they'll benefit from these trends. I'll end on the all-important disclaimer. Thank you for your time this morning, the opportunity.